we're supposed to look at expenses and income. So let us look at that. And then we're going to look at leases, which is also a very, very interesting topic. So let us first go to leases. Because I just remembered right now that we actually didn't finish. Okay. But before I actually go straight into it, how are you guys? Are you well? I hope that you guys are having a wonderful Sunday. You guys are not working too hard. You're not working too hard, okay? Um, okay, so let us begin. I'm just trying to fix my laptop here so that I can take us back to, so that we can do the conceptual framework. Let's see. Okay. Okay. So we are now looking at income and expenses, and according to the conceptual framework. Yes, we were by equity. Yes. Wait, let me see. Yes, we are here, people. Okay, you all can see the screen, correct? Okay, that's good. That's good. Okay, that is very, very good. Let us begin. So we are now looking at we were looking at assets the last time. We looked at assets. We looked at liabilities. We looked at also what is these contracts, the executory contracts. People asked very interesting questions about the executory contracts and so forth. So now we are now looking at the definition of equity. Can you guys see the slides are changing, right? Yes. Okay. So we are now looking at the definition of equity, and we said that equity is the residual interest in the assets of the entity after deducting all its liability. Basically, it's this equation. It is what is left from the assets after deducting your liabilities. That is the definition of equity. Okay. Now, there is a difference between equity and liability, right? And I'm going to give you an example. But in equity, as you can see in the screen, there is no obligation to deliver cash or any asset to the other party. Whilst in liability, there is an obligation for you to deliver cash or any other assets, and even at times that are unfavorable or at conditions that are potentially unfavorable. So I'll give you an example. There is there are your debtors and there are your investors. If you look at the statement of profit or loss or the statement of changes in equity, you can see that the debtors are first paid before the investors. Remember, investors, depending on the type of shares, investors usually you don't. It's not a must for you to give out dividends. The it is within the discretion of the board of directors whether they want to give the shareholders profits this year or not. But to people whom they have collected, to people whom they've actually borrowed money, in which it is now a liability, finance expense is an obligation. They have to pay, whether they want it or not. Okay. Now, we move on to the definition of income and expense. Now, to clearly understand these two, it's all about how is this transaction affecting our equity. Now, the definition of income is the increase in assets or the decrease in liability. I want you to note the or. means that it can't happen both at the same time. In income, it's either an asset must increase or there will be a decrease in the liability. They can't happen both at the same time. And because the asset is increasing or because the liability is decreasing, this results in an increase in equity. So basically, sorry, something is happening. I'll get back to you now. Okay, sorry about that, guys. That was my technical analyst. He was actually fixing my presentation for me. Okay, so can you guys see the slides? You can't see the slides, right? Okay, let me fix it. Okay, yeah. Okay, okay. It's better now, right? Oh, okay, perfect. Now, let us continue. So the definition of income is that there must be an increase in assets or there must be a decrease in the liability. Between the two, one must happen. And at the end, there must be a result in the increase in equity. But another thing I want you guys to note, right? That that thing, it should not be related to the shareholders contributing more money. Remember, when the shareholders contribute more money, their equity actually grows. So, when, for instance, an investor invests in the company, that is not income. That is not income. Although it's increasing our equity, that is not income. It is not. The definition of income is that there must be an increase in assets or a decrease in liability, which is now resulting in an increase in equity. And usually, income is derived from operations. It's derived from the business's operations or from the business's investment. So the businesses placed some of their money somewhere and it grew. That is the definition of income. It can come in the form of dividends, it can come in the form of actually revenue. So that is income. Expenses is quite the opposite. There is a decrease in assets or there is an increase in liability between the two. Between the two. And I'm going to give you an example for you to understand this better. So there's a decrease in assets or there's an increase in liability that is now resulting in a decrease in equity. And this and whatever that is, it should not be related to you giving out dividends to your shareholders. That is why it is written there, other than those relating to distributions to the holders of equity claims. So that is basically talking about drawings or dividends. Okay? So if an owner maybe does some drawings, or if the board of directors decide that they're going to give out dividends, that is not an expense. Even though it's resulting in a decrease in equity, that is not an expense. Okay? Example of income. Let's say the business invested in in the business invested in a those in a bank account, like a bank account that is earning them like interest, right? Now, if they receive that interest, that is income. How is it an income? Because they've invested, they've got extra money. Money is an asset. Cash is an asset. So the income it is an income because our assets have increased. which is now resulting in equity. And there was no shareholders who put any money. This was money that we earned. Expenses, for instance, we call a plumber to come and fix our offices. It's decreasing our assets because we're going to pay him. Or let's say we didn't pay him. Let's say we owe him. So now it's an expense. We didn't pay him. Our assets are still the same, but now we owe him. So there's an increase now in liability, which is now resulting in a decrease in equity. Does everyone understand income and expense? Okay. Is there anyone who doesn't? If you don't, please wave your hand. Okay. I can see all is well for now. Okay. Now, let us move on and let us go into recognition and derecognition. Now, when we talk about recognition, we are basically talking about the process of actually including a transaction in our financial statements. We're either going to include it in the statement of financial position or the statement of financial performance, which is also known as the statement of changes in the statement of comprehensive income or the statement of profit or loss. So we're going to include it in one of our statements. That process of taking a transaction and putting it in our financial statements is recognition. And the reason why we do that is because that item is meeting the definition of one of the elements of the financial statement. So it's basically meeting the definition of an asset, or it's meeting a definition of a liability, or it's meeting a definition of equity or income or an expense. So if, for instance, a shareholder came in our company and they wanted to invest more money, that resulted in an increase in our equity. There's now a change in our equity. It just increased. So we are going to what? Include that in our financial statements. And when we include that in our financial statements, then there are people who want to join here. Sorry. So when we include them in our financial statements, that is when we include them in our financial statements, that is the process of recognition. Okay. Does anyone understand what I've explained so far? Okay. Yeah, I hope you understand. Okay. Now, okay. Now, let us move on. Now, now, in this slide, what it's actually talking about is it necessary? How do we see that this is necessary? This is a transaction that is actually necessary for us to record. Is this something necessary for us to record? Is this something necessary for us to take and include them in our financial statements? How do we see that this is something that we actually recognize? How do we actually see it? By the by assessing if if we are doing that by assessing, is this item relevant, and we are assessing if this item is faithfully presented. So let us talk about it now.
Sir?
How do we see?
Excuse me, sir.
Hello?
Sir, please may you zoom in?
Oh, I must zoom in. Okay.
Yes, please. And also, please look at the chat box for any questions, just in case.
Okay.
Thank you.
Yeah, I'm multitasking, doing a lot of things. So, yeah. Okay, let me check if there's any questions. Okay. Oh, okay. Oh, can you guys see the next slide that we're on? Oh, okay. Okay, that's perfect. Okay, that's good. Now, we are looking at the recognition criteria of, so by recognition criteria, we are saying, when do we see that we should record? So how do we see that? First of all, it's the existence of uncertainty. So how do we see that? So what does this mean that the existence of uncertainty? So we see that we need to recognize this transaction because it is relevant, because we are certain that this thing might happen. And we are uncertain, and when it is uncertain, it is more relevant for us to now what to put it in. Let me give you an example. For instance, let us say we are a record label company, and we have an artist. He is still fresh. He's not well known. Okay, and what usually record label companies do is that they give the artist some money, and they hope that after they are done with their album, they will use that money, the cash flows that they get from their album, excuse me, to actually pay them back. Now, this person is new. This person is new. We're not sure if his album is actually going to be a hit. So that means that the certainty of us getting cash flows from this project is very, very low. So that means that there's a high risk. And remember, people, relevance is what relevance mean is this information has the ability to influence decisions. So if there's someone in the record, if there's someone who's interested in investing in the record label, they are also interested in the risks that are in that the record label it has involved itself in. So what it's going to do is, since it has a high risk, it is very, very important that you disclose it, because investors have different risk appetites. Investors have different risk appetites. So it is very important that the business displays all its information. And if that information is relevant, how do we assess that? It's certainty. If there is uncertainty and the uncertainty is very high, it is relevant that you do disclose it. And also, you can see the second point is also flowing from the first. If there's a low probability of a flow of economic benefits, the information is more relevant because that information can actually make a difference in the decision making of the user. Do you guys understand by what I meant by the recognition criteria? If you don't, please wave your hand. Okay, there is about more than 30 students here. So are you sure you guys understand? I don't want to miss anyone. I am more than happy to take your questions. Okay, Offense, you raised your hand. Can you tell me what's up?
Can you please repeat what you said?
Oh, okay, no problem. Let me repeat it. Let me be more clear now. Okay. Um, bef- I spoke about recognition. I said recognition is when before we take anything, I mean, recognition is us including items into our financial statement. We include those items because they meet the elements of the financial statement. So it's either they are an asset or they are a liability or they are an equity item or they are an expense or they are actually a income. Now, how do we see that this is something that we have to include in our financial statements? First, we assess, is this item relevant? But how do we see that this item is relevant? We assess it by its uncertainty. So, the higher the level of uncertainty, the more relevant the information. I'm going to give you an example, Offense. Imagine you are interested in investing in the record label company, and you see that they just um, um, borrowed money. No, they just gave money to an artist who is new and who people don't know about. They gave money to the artist, hoping that that artist is going to pay them back through their albums. That increases the level of risk for the business. Now, Offensive, you may be someone who doesn't like a high risk investment. You're not into high risk investment. So, because you're not interested in high risk investment, that information is relevant to you because it shows you that the company just engaged in a risky transaction. So, you're what? You're going to withdraw if you want, or Because, or if you are interested in high risk investment, you're gonna go in. So can you see that uncertainty is linked with risk? The more risk there is in this, the more risk there is in the transaction, or the more uncertainty there is in this item, the more relevant it is to the users. And also, if there's low probability of you to get economic benefits, then it becomes what? It becomes relevant, because if the investor, or if the bank finds out that ish, there's low probability of this company making profits or cash flows, it's going to withdraw. So again, like I said, the higher the level of risk, the higher the level of uncertainty, the lower the probability of the company making cash flows, the more relevant it is for the company to disclose that information. Do you get it? Okay, that is great. I'm glad you understand. Anyone who has another question? I don't want to leave anyone behind, guys, because the conceptual framework is one of those questions that like you need to aim good marks at. Okay, let's go to faithful representation. When we talk about faithful representation, remember in the conceptual framework we said that it must provide complete information, right? Now, we go back to the measurement of uncertainty. And like it's still the same thing as I explained before. The higher the level of uncertainty, the more important that you need to disclose to the users. Now, when we come to presentation and disclosure, that is also very important, because remember, we are providing complete information. So if it is possible that we can disclose everything and provide a complete presentation, then it is important that we recognize it. Do you guys understand? Do you guys understand? Who doesn't understand, please wave. Any questions? I really am eager in answering questions, guys. Oh, okay. Now let's move on. Let's move on to the next slide. We are almost done with the conceptual framework. I'm sure you're like, yo, how many times have we been learning about the conceptual framework? So now when we come to derecognition, what we're basically talking about is that we are removing now a part of an asset or a liability from the statement of financial position. So derecognition is only with assets and liability. You don't derecognize income or expenses, people. Don't share your own accounting, Buffet, to there at the test, please. Derecognition is only associated with assets and liability. So, how do we see that this is the time to derecognize? We assess. So, let's first look at an asset. How do we see that this is now the time to derecognize an asset? You see that by first assessing, have we lost control? Did we lose control? If we have lost control over the asset, we derecognize the asset. For instance, if I sell the asset, that means I can't control an asset. Therefore, we derecognize it. Okay? But now I want to ask a question so that I can make things interesting for this class to see if you guys may have been talking. Let's say, for instance, the entity owns 5 laptops, right? And then it decides to lease out the laptops. Do we de-recognize the laptops? Anyone who can try, guys, there is no wrong or right answer. There is no wrong or right answer. Just try. I mean, we all have brains, so we are probably thinking something. And that thing that you're thinking, I would like to know what you're possibly thinking. There is no wrong or right answer. Okay, someone is doing a thumbs down. What does it mean? Okay. No one. Okay. No one wants to try. Okay. Okay. So. Okay. So the reason why We don't derecognize it. Okay. Someone said we don't recognize we don't derecognize it. Why don't we derecognize it? You're right. You're actually right. But why don't we derecognize it? Because accounting it's more about the why. So why don't we derecognize it? Anyone who would like to add? Okay. Someone said that we still have control over the asset, but we're not using it. We're not using it. It's there at where we leased them. So how are we still having control over it? Okay, someone says it has the potential to produce economic benefits, which is true because it is giving us money. It is giving us money. That is true. But I still am interested in your control. How are we still having control if someone else is using it? Okay.
I would say it's because we didn't sell it to them. It's more like we borrowed it to them, so we still have control over it, but they're just using it for the meantime.
Yes, very true. We can take it any time from them. We can take it any time from them. Yes, they do not have the right of possession. Hmm. Okay, someone said they don't have the right of possession. Huh. Okay, they're gonna have to elaborate that more, but you're gonna get back to me. But you're gonna have to elaborate more. But what do you mean by right? Because if they are leasing it and they are paying money and they can use it, which means they do have the right. But it's okay. It's okay. You guys have a spot on. I love all your answers. Yes, the main thing is we can take it from them. We can take it from them, right? We can cancel the lease when the lease is due. You understand? When like the contract is over. So yeah. So you guys are spot on. You guys are spot on. I like the answers. I like the answers. Okay. So now, guys, we are going into leases. Okay. So leases is a very interesting topic, especially in your test one, guys, because leases is more like a theoretical question. If you can understand leases, you basically have 20 to 25 marks of out of the 80 marks that they're going to possibly test you out of. So if you can ace these guys, I'm telling you, you are sorted. You are really sorted, okay? Does anyone have any questions so far about the conceptual framework? Okay, let me check the chat box. Does anyone have any questions? Okay, let us move on because we are basically left with 26 minutes. Okay, someone asked the question. Oh, the derecognition of liability. Thank you, thank you, thank you. Silly me. It's just I'm looking at time and I'm like, oh, am I gonna get to leases? Okay, so how do we derecognize liability? I think you guys can get this. Remember, I told you that the main thing when we look at assets is control. For liabilities, how do we derecognize liability? What do we look at? How do we first get a liability? Remember that a liability is a present obligation to transfer economic resources. So, how can a liability disappear? An asset disappears because there is no longer control. So, how will a liability be derecognized? How will it disappear? Just try. Let me check the chat box and see what other people are saying. Yes, people, just try. Please, just try, guys. There is no wrong or right answer. We pay it off. Okay. Someone says we pay it off, and you're right. You're right. But there's something I'm looking for. Okay. When we pay it off, that means we don't owe them anymore. So if we don't owe them anymore, what has disappeared? Because of yes, there is no longer any obligation. Someone just answered. It's because there is no longer any obligation. If there's no longer any obligation, we derecognize the liability. Are we all sharp with recognition and derecognition? Okay, that is amazing. That is amazing, people. That is amazing. Now let's go to Leases, people. Um, just take you to the slide for Leases. Okay, guys, so we are now looking at leases. So, what is leases all about? Like I said, it's a very important topic. This one you can't cram, although it's theoretical, you can't cram. Try and understand it. And I would like, if you have any questions, please raise your hands. Now, people, please raise your hands. Now, the definition of a lease is this. It is a contract. Basically, a lease is a contract, right? And this contract, a lease, we say that a contract contains a lease if the contract conveys or the contract tells us that there is a right to control the use of an identified asset for a period of time in exchange for consideration. If you guys got your pencil and your paper around you, I want you guys to make 4 points. Okay, I want you to say lease, and then these are the the 4 main things that are supposed to be in a lease. First, they must be the right to control. And guys, we are looking at lease at the point of the leasee. There's a leasee and there's a leaseor. The leaser is the one who is renting out. The leasee is the one who is renting. Okay? Now, at the point of the leasee, how do we see that this is a lease for us? We see if we have the right to control the identified asset for a period of time in exchange for consideration. So there must be 4 things. First, the right to control, the right of control. Secondly, there is an identified asset. Thirdly, there is a period of time. And fourthly, there is a consideration. So if this contract is telling us that we have the right to control, if this contract is telling us that there is an identified asset, it's specifying the asset, and if this contract is giving us a period of time, and also if this asset and if this contract is telling us there is an exchange for consideration, then this is a lease. Consideration is another word for payment, an accounting word for payment. Okay? Are we all sorted out with the definition? Do you guys have any questions with the relating to the definition?
Can you please repeat it one more time?
Oh, you'd like me to repeat one more time? Okay. So, a lease is a contract, correct? A lease is a contract, right? But not all contracts are leases. So, how do we see that this contract is a lease? How do we see it? It's these 4 points. If you can write it down, please do. It's going to make the lesson very easy for you. First, the contract is telling us that there is a specified asset. There is a specified asset. The contract is telling us there's a specified asset. Secondly, the contract is telling us that we have the right to control the use of that specified asset. Thirdly, the contract is giving us a period of time in which we have the right to control that specified asset. And fourthly, the contract tells us that there must be consideration. So basically, another word for consideration is payment. So you are paying for the right to control the specified asset for a period of time. Are you okay now? Do you want me to repeat again, or you're fine? Perfect. Thank you for asking the question. Thank you for asking the question. Now, now we have spoken about these 4 points. Now, today we are going to be looking at 2 points basically. We are going to be looking at um, identifying the asset in a contract, and also we'll be talking about control. How do we see that we have control? How do we see that how do we see an identified asset? How do we locate the asset in the contract? I'm going to show you how you're going to locate the asset in the contract, and I'm also going to show you how do you see that we do have the right of control. That is the 2 things we're going to look at. And then tomorrow, we are going to look at the last 2, which is basically period and the exchange for consideration. But those 2 guys are so important. They weigh a lot of marks. So put on your seatbelts and let's get right to it. Okay? Now, how do you have an identified how do you identify an asset, or how do we see that the asset is identified in the contract? First, it must be explicitly specified. Let's say are we are a company that manufactures a variety of products, ne? And then we heard that China, no, let's not say China, it's too far. We heard that um, De Bronze Electronics, or A Electronics, have created a machine that can print anything, a 3D printer. It can print anything. It can make mugs. It can make clothing. It's just a 3D printer. It can make anything. Okay? So we go to Electronics, and we want to lease out the machine because we don't have the money to buy that machine. The machine costs 5 million rand, let's say, and the company doesn't have that money right now. So we would like to lease out the machine. Okay? Please follow with me in this example. Now, how do we see that this is a lease? In the contract, it must specify that we have machine, let's call this machine Z printer. So it's going to say that um, the company has leased out Z printer model 375ZXT. Can you see that the asset is explicitly specified? Can you see that? So first, that is very, very important, people. It must be explicitly specified. The second thing, although it is explicitly specified, the customer doesn't have the right to use that asset if the leaser, the one who is leasing the machine to us, has a substantive right to substitute. Now, how do we see that the leaser has a substantive right to substitute? How do we see that? Before I go there, are you all understanding me when it comes to identifying the asset, which it must be explicitly specified? Are you all with me so far? Okay. If you have any question, please raise your hand. If you want me to repeat anything, I'm more than happy to do so. I don't care about time, because what's the point of me moving fast if you guys don't understand? Okay. Let us continue then. So first of all, how do we see that this person has substantive rights? Okay. Okay. And another thing, okay, but we're gonna talk about that in control, so it's not a problem. How do we see that we have substantive rights? So, first of all, we actually see that by assessing the following things. If the leaser has the ability to substitute that asset throughout the period of use, then we don't have the right to use the identified asset. Do you guys understand what I just said? Do you guys understand what I've just said? Okay, I'm gonna repeat that again. If let me use the machine example. Let's go back to our machine example. We said that when we are identifying an asset, how do we identify an asset in the contract? Okay, there's someone who sent a question also. Let me see if it's also related. Okay, no, things are still okay. Now, I said when identifying an asset, we should look at two things. First, the asset is explicitly specified. But even though the asset is not, even though the asset is explicitly specified, we don't have the right to that asset if the supplier has a substantive right to substitute. How do we see that the leaser has a substantive right to substitute? If the leaser has the ability to to substitute that asset they leased to us throughout that period, then we don't have a right to the asset that they gave us. Let me give you an example. Let's say they gave us the Z printer, right? The company A Electronics has a lot of A printers. And they told us that, guys, we are giving you this Z printer for 5 years. If during the 5 years they can anytime come and say, no, we want to take this Z printer and give you the P printer, then that means we don't have right to that asset. Do you understand? By the example again. If you don't, it's fine. Please don't be afraid to ask questions, guys. Don't be afraid. Raise your hand if you have to. I'm not afraid to answer your question. Okay, I'm going to say that again. How do we first of all, the 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 leaser, if he has substantive rights to substitute the asset, then we don't have rights to that asset. How do we judge that this supplier has a substantive right to substitute? First, this this person who's renting out the machine, if he can come anytime and choose to substitute the asset that we have, which is the printer, with another printer during the period in which we agreed we're going to use it, then this person has a substantive right. And if they have a substantive right, then we don't have a right to the asset. We don't have a right to use the asset. Secondly, if the leaser, if he substitutes the asset, if the benefits of substituting the assets are more than the cost of substituting the asset, then the supplier or the leaser has substantive rights. Do you understand? If you don't understand, please don't say sharp, okay? Okay. Oh, okay. I can see someone doesn't. Okay, there's someone who doesn't understand. Okay, there's someone also who doesn't understand. Okay, that's why I said I prefer that you guys have a paper around so that you can do this thing better. Okay, let me do this. Okay, I opened up the wrong slide, guys. Let me open up the right slide for it so that you guys can see what I am also showing you guys. So that you guys can see what I'm talking about. Okay, now let us talk about these substantive rights. Okay, now let me read it out. Okay, an asset first must be identified explicitly, and you guys can see that, right? It must be identified explicitly first when identifying an asset. Secondly, guys, even though a customer does not have the right, okay, even if an asset is specified, a customer does not have the right to use an identified asset if the supplier has substantive rights to substitute. Now, how do we see that the supplier has substantive rights to substitute? First, we look at, does the supplier has the practical ability to substitute alternative assets. So that means the lessor can come and take, for instance, we rented out Z machine. So they can come and take Z machine and give us another alternative of Z machine. Maybe they give us P machine throughout the period in which we agreed. So if they gave us 5 years to use Z machine, and then suddenly the supplier comes and they say, no, you know what, I want to take Z machine, use P machine, then we don't have the right to that asset. Secondly, the second point that we should look for when to see if this person has substantive right to substitute, if he can come, and if taking Z machine will give him more money than the cost that come with taking it, then he has substantive rights. Let me give you an example. So if he can come and take Z machine, if he's gonna make more money from taking Z machine than the cost from actually taking it, then he has substantive rights. Let us read here. It's saying, if the supplier would benefit economically from the exercise of substituting the asset, meaning that the economic benefits associated with substituting the assets are expected to exceed the costs that are associated with substituting the asset. So that means that if I am the leaser, if I'm gonna benefit more, if the benefits of taking the machine exceeds the cost of taking the machine, then yes, I do have substantive rights. Do you understand? If you don't understand, I'll repeat it again. Okay, to those who did say thumbs down, do you understand? Okay. Okay. Um, okay, I'm going to make a post note for that. Okay, I can see we're actually left with 6 minutes. Okay, let us do this. Are you guys available at 8 so that we can talk more about this in detail? And I can also look for more examples. Are you guys available? So that it's gonna be, I'm not gonna take much of your time. I'm gonna take 30 minutes. Can I see if you guys are gonna be there? Can I please have like waves? If I can get 30 waves, I'd be really happy. From everyone who's there, like the waves. Okay. Yes, those lessons are actually gonna be recorded. Don't worry, they are gonna be recorded. It's just the thing of remember that I am also working under someone, so he's gonna give me more details as to that. Let's see how many people raise their hand. Please, if you're gonna be there, I can see only 2 people have raised their hands. please, I need at least 20. If you think you're gonna be there at 8. Please don't do sharp, although I do appreciate it, but like a hands, like a wave, so that I can keep count. Because the sharp emoji disappears. Okay, so we have reached. Okay, okay. So at 8 o'clock, I'm gonna send a link. I'm just gonna spend probably 30 minutes. So right now, I'm just gonna look for examples because also we are running out of time. I'm also gonna look for more examples so that you guys can understand. Okay. Okay, guys, I am going to see you on 8 o'clock. So avail yourselves, okay? You guys enjoy the rest of your day. Does anyone have any questions besides the substantive rights thing? Okay. Then, guys, I will see you definitely on at 7.